So we've seen a bunch of really strange things today. Tomorrow, obviously, is a CPI report, and the first thing that really stood out today was Oracle going up some 36% in one day on these supposedly deals that are coming. Apparently, OpenAI signed some sort of $300 billion contract for compute with Oracle. I don't even know where OpenAI is going to get that type of money from. I guess they're going to be doing a lot of capital raises over the next couple of years. But the stock is obviously trading up pretty big, and you obviously have other names in the space also going up as well. Although on the S&P, it's a pretty quiet day, actually. The index itself is only up to 11 basis points, at least as of 3:30 in the afternoon, and the RSP equal weight is probably more reflective, is down 30 basis points, and the QQQs, which are the NASDAQ 100, is actually down 25 basis points, and the QQQE, the equal weight, is down over 1%. So it really gives you a sense of what's happening in the market. There's just a broad sense of you have a couple of stocks, again, doing well, kind of masking the overall performance of the index. But really beneath the surface, there's a lot of things that are going on that aren't that great. And again, when you look at the S&P, here was that gap opening following the weaker PPI report today. And you can see we've basically been working to close that gap ever since. And what's interesting about today also is that we obviously had that weaker than expected PPI report. And just to go back to the first chart you saw, which was this one. But before we get too much into the data, please remember to subscribe to this channel, like this video, share it with your friends. I am trying to grow the channel. I need your support to do that. This is showing you basically the VIX 1-day, which is a really good gauge that I like to use to give me a sense of where implied volatility is heading into an event. Typically what happens the next day is we see a pretty big reversal, meaning implied volatility will drop sharply. So this was the last payroll report. The VIX 1-day went out at nearly 14. And then, of course, the next day it opened down here around 8 or 9. And if you remember that day, actually, what's interesting about it is if we take the S&P 500 chart and then we put it on a 5-minute scale, and then if you look at the VIX 1-day, what you see is that initial big drop in the VIX 1-day, implied volatility falls, which is what typically happens once we pass a news event. Market rips higher at the open, and by the end of the day, we gave that all back. And, if you notice, we opened up about 40 basis points. So a VIX 1-day probably going out at around this level of around 13 or 14 is probably not going to result in too big of a volatility crush following the CPI report tomorrow. But it may be enough to push it a little bit higher, at least initially. And then kind of what happens after that's going to be dependent upon, the actual data and other things that are going on in the news. But you can see how implied volatility plays a really big role in the setup into these event risk. What's interesting about today, though, is I don't think necessarily, though, that today's sell-off is that we're seeing in the S&P 500 really has to do with tomorrow's CPI report, though, because when we look at the 1-day implied correlation index, that is trading down a little bit today, but it is well off its lows. We are seeing the dispersion index also trading down today, but we're actually seeing the VIX index trading higher. And this is slightly different than what we saw on that Thursday going into the job report. In fact, on the Thursday going into the job report, we saw implied correlations trade down. We saw dispersion trade down. We saw VIX trade down, and we saw the VIX 1-day obviously trade higher. Today, you're not seeing that. And so I think what was happening going into the job report was people were selling longer dated volatility and buying the shorter dated kind for the protection around the event risk. That's not what's happening right now. We are seeing implied correlations come down. We are seeing dispersion come down, but we're not seeing the VIX going down, and we're actually seeing it rise, which may mean that what we're actually seeing taking place in the market is actually some longer term hedging potentially going on. And you're seeing a really big move up in the VVIX. So that's the volatility of the VIX. And so when this starts going up, that means volatility within the VIX is going higher. And that also is a really good indication of where volatility is directionally heading. And so it seems like when we look at today's price action, the sell-off that we're seeing is really due to just real selling that's going on in the marketplace and not really nervousness that we're seeing going into this into the CPI report tomorrow. And so obviously with the weak PPI report today, you're seeing the 10-year rate kind of just coming back down to the end of the range at 404. I mean, generally speaking, when I try to make my when I try to do these presentations for you and for everybody really, is I'm trying to make a reasonable assessment on where things are going based on the data that I'm seeing. And the job market appeared to be fairly healthy going into the July report. Then all of a sudden, the July report comes out with these massive revisions. And then all of a sudden, the August report comes out and confirms those revisions and is also weak. And then, of course, yesterday we get those other revisions. And so all of a sudden, the job report is much weaker than what we thought it was. And so this is why you're now seeing not just, rates going down, but this is why my view is honestly beginning to change on where rates may even be heading. And I really need to see a little more data before I can confirm that. But, when you think that when you think that the labor market is doing something only to find out that the data was wrong, it leaves you to feel uncomfortable in terms of trying to assess where rates are going. But I mean, at this point, when you look at the 10 and 30-year rate, I mean, you really have to wonder, how much can these things really drop if they should start to drop? And obviously, previously, I was expecting that we were going to see 30-year rates move back up over 5% because it looked like the labor market was healthy. Obviously, that was, incorrect data, and so we have to kind of reassess that. Now, also tomorrow, we're going to be getting initial jobless claims and continuing claims, and those are going to play very heavily into whether or not we're going to see rates rise as well, or fall for that matter. And you're also seeing the dollar moving a little bit higher today, although not very much. Now, higher unemployment, lower job hires, potentially a hotter CPI brings us more towards that stagflation angle. If we do have labor markets that are weakening as much as the data suggests, and we get a miss on CPI, it probably just puts us more in that growth slowdown camp as opposed to having to worry about both inflation and slower growth. We would just be worrying more about the slower growth, and that changes the dynamic around where rates are heading to. So lots of things going on in the market. I think we just need to give it a little more time to even out. But clearly today's movement, despite the big moves we've seen in a couple of stocks, really to this point around 3:30 in the afternoon, not being reflected in the broader indices, and you're actually seeing quite a bit of weakness underneath the surface. So again, we'll just see how things develop the rest of this week. And please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you soon.